Welcome, everyone, and thank you for joining our webinar today. Our topic is private equity investment in oral surgery. A few things to keep in mind throughout the presentation. All attendee lines will be muted. At the end of the presentation, there will be time for questions. You can ask questions by typing within the Q&A section, which is located in the black control bar, likely at the top or bottom of your screen. This webinar will be recorded, and it will be distributed later in the week. Today's speakers include Abe Mboj, Associate at Provident Healthcare Partners, Dean Gould, Associate at Dykema, and Craig Woods, Member at Dykema. I'll now turn it over to Abe to give a brief introduction on Provident.
Hi, everyone. Thank you for taking the time to join our webinar here today. Appreciate everyone making the webinar. So just to get started, a little bit of background about our firm. Provident Healthcare Partners, we are a healthcare-focused investment banking firm that's been around for about 20 years, working on M&A transactions within the lower middle market of healthcare services. We define kind of the lower middle market of healthcare services that we're working in on transactions anywhere from $10 million on the low end all the way up to $500 million on the higher end. Over the last few years, we've carved out a really nice niche within physician practice management transactions. So name a specialty, we've done a lot of work within this space. Dermatology, ophthalmology, gastroenterology, urology, dental practice management, pain management, orthopedics, name a specialty, we've kind of done work in this space. And I've closed 55 physician deals over the last 6 years or so. We're about 20 investment banking professionals and $1.1 billion of transaction value closed since 2017. I myself, again, Abe Mboj, I'm an associate with the firm. I'm based out of our Los Angeles office, and we're headquartered in Boston. So with that said, I'll turn it over to Craig and Dean to give a little background on Dykema.
Dave, thank you for that introduction, and thank you to everyone on the line today for attending. I'm under no illusions here. I'm playing second fiddle to Provident. I know who's got a lot of information they're going to go through that everyone I'm sure is interested to hear. Dean and I are with a law firm, and we appreciate everyone for taking time to listen to a couple lawyers speak about legal issues in the healthcare M&A sector. We are with a law firm called Dykema. We've been around since 1926. We're one of the top 150 law firms in the country, and we have more than 450 professionals having experience in 65 distinct practice areas. Our group in particular specializes in healthcare M&A and regulated markets. Dean and myself are members of our healthcare M&A group. I am one of the leaders in that group, and Dean and I work closely together on many of our firm's most important transactions. We, over the last couple of years, the statistics here sometimes are hard to track. The number on the screen says 100+ healthcare transactions. I think if you count them all up, it's probably in excess of 200 transactions. Not all of those fall squarely in the middle market range of $10 million to $500 million. We have some that are smaller than that. We regularly assist our clients in setting up regulatory compliant MSO and DSO structures. We work on kind of garden variety regulatory questions that come up for both management companies and for practitioners. But we also assist on both sell side and buy side with large healthcare transactions. And so I would say if you kind of look on an average year for us, we're probably about 60% on the sell side, 40% on the buy side, but it just kind of depends on the type of deal that comes in the door. We have 47 deal professionals in our group. Dean and I work out of the Dallas office, but we have attorneys in all of our offices that assist us on a regular basis on issues relevant to the healthcare M&A space. We're excited to talk to you today about some of the kind of unique legal issues that come up in transactions of this nature. Hopefully, you'll be able to take away some of this information we provide you with and use it in your businesses and in your everyday practices. Thank you for your time, and we look forward to talking to you more. With that, I'll kick it back over to Abe.
Great, thank you. So again, to kind of start off here, the topic of the webinar is private equity investment within the oral surgery market. So figured it was prudent to start off with kind of a market landscape of the oral surgery space. So private equity investment really began to pick up in the space during the third quarter of 2018 with the formation of U.S. Oral Surgery Management, in conjunction with Riverglade Capital and the Thurston Group in combining two groups, Austin Oral Surgery and Oral Surgery Associates of North Texas. So U.S. Oral Surgery Management started as a platform with an investment into those two groups based in Texas. Following that investment, U.S. Oral Surgery has really expanded across the country. This map at the bottom here shows the kind of breadth that they've been able to create. First, they expanded into Colorado, and then into Georgia, into Tennessee, into Alabama, and into Minnesota as well. So they've started with their platform. Additionally, in addition to expanding into those other states, they've also expanded pretty broadly across Texas as well, which is no small feat for a practice management organization to do, given the breadth that exists within Texas. But given the success of that investment, you've actually seen a couple other platforms get formed within the space. In Tandem Capital invested in Nebraska Oral and Facial Surgery, Omaha Oral, and Advanced Oral. They brought those three groups together to form a group called Paradigm Oral Surgery. And Sheridan Capital Partners invested in Oral Surgery Partners as well, based in Missouri. So the interesting thing is now that you've had one private equity platform, being U.S. Oral Surgery Management, that saw quite a bit of early success. Now today they started with about 15 doctors, and they're north of 80 doctors and 60 locations. At this point in time today, following that success, you've seen other private equity firms get interested and create platforms in the space. You can see over on the right here a transaction timeline of all these deals within the sector. And the interesting thing is, now that we've seen these two other platforms get formed with Sheridan and in Tandem in Oral Surgery Partners and Paradigm Oral Surgery, the expectation is that you'll actually see a lot of this transaction activity accelerate from this point forward as those groups look to go out and really replicate what U.S. Oral Surgery Management has done in creating additional regional hubs around the country, and then follow on add-on acquisitions after that. I think, again, looking at this map, you can see while U.S. Oral Surgery Management has had a lot of success and grown pretty rapidly into a lot of different geographical regions, there's still a lot of white space within the United States market for expansion and investment from the private equity community into the oral surgery space. I think one of the key driving factors of investment into the sector is just how fragmented a lot of these groups are. It's fairly uncommon to see oral surgery groups with more than 5 doctors within any single practice, and it doesn't take a ton of doctors to be throwing off a few million of adjusted EBITDA, which becomes important from a transaction standpoint. So it's really caught the eye of the private equity community, and the success of U.S. Oral Surgery Management is only going to drive that further. And so diving into that on the next slide, We'll take a look at, you can see oral surgery is really still, even though you had U.S. Oral Surgery Management have a lot of success early on, you still can see that there's a lot of room for growth and investment by the private equity community. We would still characterize this as a segment of physician services that's in its infancy from a private equity investment standpoint, along with some of these other sectors here, gastroenterology, urology, OB, and orthopedics. But looking at some of the more mature segments, such as dental or dermatology or ophthalmology, you can see that once private equity investment really starts to pick up, based on the investment dates, right? If you look at ophthalmology in 2014, that was when the first platform was created. Fast forward 6 years later, there's 22, right? We're only 2 years removed, and really, 2020 just started, so we're about 1.5 years removed from the first investment into the oral surgery space, and there's already been 2 subsequent investments. So we would expect that you would see private equity investment continue, and additional platforms will be created within the oral surgery space, much like some of these other segments of physician services. And private equity firms are going to look to replicate the successes that have already been seen within the space for certain. So moving to the next slide. So what are the strategic options that exist for oral surgery practices? And we think of these in 3 buckets from a private equity standpoint. So the first is obviously to remain independent. We'll start there because that's kind of the easiest to explain, right? Everything stays the exact same as it is today, and the practice can remain independent, the structure doesn't change, and it's kind of the status quo. I think option 2 is more the pure play private equity investment, platform model. So this provides the opportunity for a practice to take on investment from a private equity firm that would make an investment in the organization and look to leverage their skills and resources to help them grow their platform. So not unlike what Sheridan is doing with Oral Surgery Partners or U.S. Oral Surgery Management did with Austin Oral, or in tandem is doing with Nebraska Oral. So this, gives you the opportunity to be the first platform investment. Typically at this scale, you have a lot more infrastructure created for the investment, and you have the ability to leverage the billing and management and scale and resources of a platform that can expand that scale of services to small organizations and really be a value add to smaller oral surgery practices that need some sort of partner to help them navigate the current healthcare environment. Option 3 is joining a private equity-backed organization. So this would be akin to joining U.S. Oral Surgery Management or joining Paradigm Oral Surgery or Oral Surgery Partners. And what this allows the opportunity to do is you can still benefit from a lot of the aspects of partnering with private equity, right? There's an opportunity to have equity in at what can be a nationally growing management company that would allow you to diversify your equity value outside of your practice. Typically, our clients tend to choose this route. They feel that there can be a lot more certainty on kind of the second bite of the apple as the group has already kind of proven, their model. For example, if you were to join U.S. Oral Surgery, you've seen U.S. Oral Surgery execute a fair number of transactions, and you can talk to those physicians about how those deals have gone post-closing, and you can get a feel for how that investment is going, whereas option 2, you're kind of starting from scratch on day one. So there's something to be said for leveraging the groundwork that's been put in by a private equity firm and a platform and joining at a later point in time. I think it also it can't be understated, though. You're joining another organization, so you're still plugging into the platform that exists. And typically, we like to think of these in ranges of kind of autonomy, right? So on the left, fully independent, fully autonomous, nothing really changes. In the middle, you're taking on investment from a private equity firm, but you're still in control of a lot of the day-to-day operations, right? Private equity firms aren't day-to-day clinicians. They're not, going to be day-to-day running the operations of the business. They're making an investment in a business that they believe already has the capabilities to be run efficiently and could be expanded to other practices. But, everything is still being built off the backbone of that original platform investment. And then option 3, your organization is joining up with another platform that can leverage some of the best practices that they have in place for you all then to continue to grow your organization and reap some of those benefits as well. So moving on to the next slide. So comparing becoming a private equity platform versus joining a private equity backed company. And this is kind of what I was just discussing. So some of the pros, again, both provide an increased access to capital. I think, in becoming a platform, you have an opportunity to leverage the private equity firm for board-level strategic support. So, again, they don't want to be involved on kind of the day-to-day nitty-gritty of operations, but they do want to be able to help guide the direction of the company. They can leverage, things that they've seen in prior practice management investments as to how they can help grow this business or challenges they may have faced in other businesses or have relationships with, executives that could help bring some deeper experience to the platform. You generally are going to have board seats, on the MSO if you're the initial platform investment. Your infrastructure and everything you've, again, built to this point in time is being leveraged for growth into the future. And so, again, you're kind of using your organization as the starting point, and everything's being built from there, which provides a little bit more autonomy. And you're starting on the ground floor. Again, you are taking more risk as a private equity platform because it's a new investment, new venture. You're going to find the right private equity partner that you and your organization believe in and going to go out and grow the business. But you're still starting at the ground floor, which is a little bit different to the private equity backed option. Some of the drawbacks, obviously competition from other oral surgery platforms. So, there's 3 in the space. There are going to be others that come to fruition through transactions that are ongoing right now. People have seen the success that U.S. Oral Surgery Management has accomplished, and other private equity firms are certainly going to enter the space. That can become difficult as you think about what's our value add as a practice compared to some other large oral surgery practices out there that are exploring, being platforms. It's a longer time period to the secondary liquidity event. So as I was kind of referencing on the last slide, sometimes that certainty towards, that secondary liquidity event or second bite of the apple, sometimes you may hear it referred to as, is something that a lot of private equity-backed companies, especially if they've been operating for a few years and have a track record of success like a U.S. Oral Surgery, generally they're going to be closer to their second liquidity event with another private equity firm or whatever that may be down the road than you as an initial platform, because you're just kind of starting out and building from scratch. Along those same lines, no immediate best practices or management to leverage initially. Again, you're kind of putting those pieces in place. Ideally, a platform will have a lot of this in place to start, but certainly there's going to be things that are going to need to have additional investment for growth in the future. And I think that the other thing with a platform is it's just not an option for all groups. You have to have a lot of pieces in place, which we'll talk about what those are in a subsequent slide, to be able to have the capacity to be a platform to go out there and grow. And there's a certain scarcity value that exists, for platform caliber groups. I think in joining a private equity-backed organization, again, you have the increased access to capital. You're getting access to experienced management teams and private equity investors. So again, using U.S. Oral Surgery as an example, if you were to talk to that organization or partner with that organization, you're gaining access to a management team that's done, at this point, 14 plus transactions in the oral surgery space, has learned how to integrate those into their organization. There's challenges that they've uniquely faced that a lot of other people haven't faced at this point in time, that they can use their skills and experience to benefit your organization as you join up with them. A lot of times with private equity-backed groups, there can be certain opportunities to gain leverage with payers or benefit from improved rates, especially with groups that have a lot of scale in any given geographic region. A lot of times they'll have better rates with payers than smaller groups within that same region. And if you join with them, you can quickly be shifted over to their rates, and that can allow for a lot more income repair than you may be able to see under a platform transaction. The rollover equity is diversified across a larger network of practices, right? So if you are in California, a market that U.S. Oral Surgery is not in today, and you did a transaction with them, you would likely take equity in U.S. Oral Surgery Management, the overarching platform company. So now your equity value as a shareholder is diversified outside of just your practice in the state of California, but now you benefit from any growth that U.S. Oral has in Texas or Colorado or Minnesota or Georgia or Alabama. And so you're benefiting from a nationally growing organization rather than being just confined to the equity growth of your practice here in California. Ability to share best practices operationally and clinically, that goes into just having access to the experienced management team and investors. You have an ability to diffuse ideas and get to understand what's working for groups, what's not working for groups, and that can be very beneficial as well. And as we had already referenced, potentially a shorter time frame to a secondary liquidity event. Some of the drawbacks, had talked a little bit about this on the previous slide. Again, you're joining an already established organization, so unless it's a major landmark transaction, like the type of transaction that's going to double the size of the existing platform or something like that, typically you're going to have a pretty limited opportunity for board level representation and voting power if you're joining up with the existing organization in more of an add-on capacity. The existing management team and infrastructure is in place, so a lot of times you have to come to an understanding that you're not leveraging your practice as much as you could be in a platform scenario. And the last point, which is pretty relevant, the equity can be highly priced depending on the life cycle of a private equity-backed investor. And what we mean by that is if you join U.S. Oral Surgery Management, they've done a lot of transactions. They've expanded outside of Texas into 6 different states. It's just a much more valuable company than it was when they originally did their first deal in August of 2018, right? And as a result of that, the share price that your equity would be purchasing into when you join that organization would be higher. The flip side of that is look at Oral Surgery Partners or Paradigm Oral Surgery in Tandem's platform and Sheridan's platforms. Those are newer, right? So they're probably going to have a little bit lower share prices than U.S. Oral Surgery Management. And then the absolute flip side of all of that would be joining a platform where you're kind of day one founder's equity of the business, so you have the lowest share price possible. But moving on to the next slide, we'll talk about some of the attractive qualities of an oral surgery platform. So as we had talked about, there is a scarcity value, and I think in oral surgery it's even more pronounced than some of the other segments where we've done work in. There's very few oral surgery practices out there that actually qualify as a platform and contain enough of these aspects that we have kind of listed here on the screen that a private equity firm can actually put capital to work and leverage the base infrastructure of the business to go out and grow it. But some of the most important things within oral surgery, diversity of referral patterns from existing DSOs. You don't want to be having too much concentration there. That's a big investment risk. Payer mix, investments in facilities and infrastructure and equipment. Do you have a management team that can go out there and help you kind of integrate new add-on acquisitions to your platform? What's the EBITDA base of the organization? Typically with an oral surgery for a platform, you're probably looking at starting EBITDA of somewhere between $4 million or higher for a lot of these organizations. And so within oral surgery, that tends to not be that common. There's a lot of groups, and this is what's attracting a lot of the investment. There's a lot of groups in the kind of 2 to 3 range, but very few in that kind of 4 or 5 million of adjusted EBITDA range. So once you get in that range, that starts to be very attractive to the private equity community as a platform. And also geographic density. So as you look to expand the platform, geographic density becomes important because you can gain leverage with payers more quickly and have an opportunity to increase rates pretty fast. And so on the next slide, what are the things that shareholders should be considering within a transaction? And I think there's a lot of factors to consider, but these are a few that we've kind of outlined here. Shareholder motivation. So what type of transaction does the shareholder base want to pursue? Do they want to become a platform? Do they think that it makes sense to join up with an established group that's closer to their second bite of the apple? What are the growth objectives of the organization? What are the avenues that are available for growth? And these are all things you want to kind of consider ahead of pursuing a transaction. What's the infrastructure that exists today? What can be leveraged? What value does our practice have that other oral surgery practices out there in the market are missing that we could have as a value add, right? Whether it's technology, our management, our infrastructure, our relationships. What can we leverage from a corporate standpoint that other groups don't exactly have? Time horizon, how long are the shareholders expecting to be involved in the business? Are they looking at a transaction as more so some type of liquidity event as they head towards retirement? Or are they younger and looking for a transaction that can really help them take their business to the next level because they want to be around for the next 10, 15, 20 years and involved in the business and build something bigger? What's the strength of the existing management? Does the management have the bandwidth or capacity to undertake future expansion and growth? And then, what's the risk tolerance? So how many chips would the shareholders like to take off the table, if any at all? Really, this comes down to how much equity would the business owners like to keep, and that goes back to kind of the time horizon and objectives of a transaction, right? Do you want to sell 80, 90% of the equity of the business, even perhaps 100%? Generally, that's not. Buyers don't like to see generally 100% sales in physician businesses, but how much do the shareholders want to take off the table? Do they want to find a partner for growth and keep 49% of the business, or even look at a minority transaction? So all of those are important things to consider with these transactions. And moving to the next slide. So ahead of a transaction process, how should groups prepare? I think we like to think of things in three sort of buckets: strategic considerations, operational considerations, and financial considerations. So from a strategic standpoint, talked a little bit about this. What are the key growth opportunities that are available to the organization? Before going to market, you've really got to sit down and think about, what are the avenues for growth? Why would an investor want to invest in our business? What are the things that we can do within our market that other groups in other markets can't do? Are there a lot of other oral surgery practices here? Do we have very strong relationships within the market? Are there opportunities for de novo growth and building out additional centers? Do we have a strong recruiting pipeline? So you want to think through a lot of those things ahead of going to market, because you want to be paying that appropriately to investors within the space. Are all the shareholders on board for a transaction? Typically there's a lot of education that needs to go in up front to make sure that everyone's on board, because the last thing an investor wants to see when you're in the middle of a transaction process is dissent within the shareholder base as to whether this makes sense or not for the organization. And granted, some of that always comes down to the actual terms of the transaction, but generally the shareholder base needs to be on board with finding the right partner and obviously the right valuation and structure. And then even more importantly than that, taking that a step further, are the stakeholders on board for a transaction? So generally within oral surgery, the productivity is pretty concentrated amongst a few physicians, and sometimes not all of them are shareholders. And anytime you're making an investment in a business like that, from an investor's standpoint, they want to make sure the stakeholders are on board for a transaction or invested in the future growth of the organization as well. So a lot of times, especially with oral surgery groups, we end up bringing associate physicians or key management team members into the fold as well, if they're a meaningful portion of the productivity. Operational considerations. Does the team actually have the bandwidth to evaluate partners in an orderly and efficient format? A transaction process takes a lot of time, and there's a big time commitment involved. So it's important that the group has the time and bandwidth to undergo that process. Are the corporate documents and leases and articles of incorporation, are those items readily available? The due diligence process is very arduous, and so you want to be able to pull that documentation relatively easily. And also, can the organization pull data from the EMR system with relative ease, as the investors are going to want to evaluate things on a per unit economic basis? And that's very important as well. And then lastly, financial considerations. Does the organization keep the financials organized appropriately? Can they evaluate the trends by location and service line? What are the add backs that need to be made to the adjusted EBITDA within the financial statements to reflect the true go-forward cash flow of the organization? Those are all things you want to be thinking about. And then what will be the impact of converting from cash basis accounting to accrual accounting? So generally, most physician practices are accounting on a cash basis. All transactions are done on an accrual basis. So you want to look at what that change could look like. And generally, for a growing business, it's going to be a good thing, but you want to make sure you're evaluating that ahead of going to market. And so with that, I'll turn it over to Dean and Craig to talk more about kind of the legal side of private equity investment in the oral surgery space.
Dave, thank you for that. Everybody now, you get to listen to the lawyers speak, so you guys, I'm sure you've been interested up to now, so you can all go to sleep hearing the lawyers talk about the different legal structures and legal issues relevant to the oral surgery space. Abe's presentation touched on a lot of really great items. I think that obviously, from our end, what we're seeing out there is that there certainly has been an uptick in the interest in the oral surgery sector. And, oftentimes we get calls from clients and they say, what does this mean for me? When I sell my practice, what am I really doing? And so the first thing that we really wanted to talk about today is, what does the typical kind of, vanilla garden variety structure look like, and why? What is the consideration behind putting these structures in place whenever you do a transaction? And so the driving consideration behind all of these different models is really to comply with corporate practice of medicine and dentistry. So on the oral surgery side, it's a little bit different. You have to comply really with both. You have corporate practice of medicine and dentistry, both obviously regulated by state dental and medical boards. And so you have some unique considerations there. And in a nutshell, what these structures do is they try to navigate, or they do navigate, that regulatory environment. And so what you do, and what most of these private equity groups set up, is that they set up a management company structure. And the management company structure is intended to facilitate the transaction. And so what the management company does as part of a transaction is it acquires all of the non-clinical functions of an oral surgery practice. So that is everything from billing, procurement, that's your non-clinical assets like your dental equipment, your oral surgery equipment, chairs, any type of assets that would be used to support the back office functions of the practice are acquired by the management company. There are various different structures that different groups use. Some keep the existing practice in place. Others set up a new clinical entity. But at its core, they look somewhat identical, with a non-clinical management company at the top and an existing practice in place. And the buyers they're going to be selling 99% of their assets into the management company. And so if we can move to the next slide. So this right here is just kind of a typical overview of what a management company structure looks like. Dean is going to explain kind of what our diagram shows here.
So as Craig was saying, here is a illustrative example of a really garden variety management structure, PC structure. So you'll see the dotted line really delineates and bifurcates the functionalities between clinical and non-clinical. On the top half, on the non-clinical side, the management company, which is where the non-professionals, the private equity company can actually invest, holds all the non-clinical assets, the equipment, the leases, the equipment, and they provide certain services, as Craig referenced, to the PC, and in return, the PC will pay a fair market value management or administrative fee. The PC owner and the management company will also enter a continuity agreement to handle certain issues related to the death or disability or loss of dental or medical license of the PC owner. But this is the way it has to function in order to allow non-professionals to invest into the success of oral surgery practices, and to make sure that the structure is in line with the corporate practice of medicine and dentistry doctrine. So if we take a look at the next slide, what we have here, and Abe alluded to a lot of these, this is, again, a high-level overview of the transaction process in oral surgery. So we have, obviously, there's going to be a letter of intent or term sheet signed, a non-binding agreement. And so before we get to the letter of intent or the term sheet, we have to do some cleanup and some housekeeping. And so we'll discuss in more detail on a subsequent slide things to handle pre-letter of intent. During the letter of intent stage, we will then handle negotiating certain deal points. While non-binding, it can provide a lot of, certainty as to what the deal terms are. And then once the parties have reached a letter of intent, they'll enter into the quality of earnings and the financial analysis stage. Hopefully that stage comes back with what everybody intended the price to be. If not, then the parties can negotiate other contingent payment and earnouts, and that can be another consideration when negotiating the definitive agreements. We'll get into more detail on the legal due diligence, as Abe alluded to, and to what the principal documents are related to these types of transactions. So if we move to the next slide, Craig's going to talk about considerations pre-letter of intent or pre-term sheet.
Thank you, Dean. There's a number of things that can be done kind of in this preliminary stage. I mean, oftentimes the lawyers, a lot of times we're brought in late in the game after an LOI is already signed sometimes, and we don't have an opportunity to really talk to clients about these issues. And so this is just a great chance to kind of, for those on the phone, to talk a little bit about some things that you can do on the legal side to really position yourself for a successful transaction event. One of the things that we always advise our clients to do is to do a little bit of a preliminary kind of regulatory review of their current operations. We personally believe that it's better to know now than to know later if there are issues facing your particular practice, issues that might touch on Stark and anti-kickback as well as fee splitting. By working with the right folks, you can kind of walk through those issues and hopefully minimize their impact so that at minimum, you already know about them beforehand, and they're not things that are going to pop up later in the process and surprise you. While you hope that the people that you are opposite the table from are going to treat you fair and negotiate with you, kind of with eyes wide open, I'd be lying to you if I didn't say that some of these issues and some potential buyers out there will use these opportunities to leverage their position. And so we think the best way to get a handle on that is to know early on and to try to get a handle on that before they come out later on if they exist. Another issue on the regulatory side that we see a lot of is the classification of service providers. In many instances, people are set up as employees, and in other instances, we see people use independent contractor agreements. And buyers in particular have a lot of sensitivity on this issue. If your service providers are improperly classified, and they need to be converted over to employees, that's where we commonly see it. People are improperly classified as independent contractors when they should be employees. That can have a significant impact on the potential transaction. And so knowing about that early on and trying to have a plan for dealing with it is very important. Also, billing and coding issues can sometimes come up. We're not saying that, I know everyone tries to do the best they can. Sometimes in transactions you can see where folks have been using improper billing codes. Maybe they just didn't understand fully what needed to be done, and that can have a significant impact. If there has to be a change to the way that the billing is being handled, that can have a significant impact on the bottom line. Other issues that typically come up that you can kind of solve for early on, there are always tax issues. How the entity is set up. Is it an S corp or is it taxed as a partnership? This can have an impact on the disposition of the assets as well as how that rollover piece that Abe described. If you are getting equity in the parent company or in the buyer, how that equity is going to be held post-closing, and whether you can actually distribute that equity and hold it individually as opposed to through an entity can have significant impacts on you long term. And so being able to plan for that ahead of time and trying to take appropriate steps to, if there's any restructuring or other things that need to be done to try to fix those issues, it's better to do that earlier than later. Also, too, we always recommend that folks take a look at their governance documents for their, for the selling entity. I can't tell you how many times we get into the banker's boxes of documents and start digging through things, and we notice that there aren't proper documents in place. There may be, it may show that there's 15 partners, and we know that as of today there's only 2. And so getting those issues cleaned up early is very helpful because a buyer is going to ask you to clean those things up during the process. And then, there's always other, just kind of unique issues that pop up, unique to particular clients. It's not the same for everyone. It can be anything from retirement of key employees. So we have sometimes clients that come to us and say, hey, we're all equal owners, but I'm the founder, and we've all agreed I should be paid a little differently. All of these issues, we've faced before, and again, it's early. It's always good to deal with these before you get to a full-blown process, so you can handle those in a timely manner when you're not scrambling around trying to get a deal closed. If we can go to the next slide, please.
So the next stage in the transaction process, we'll move to the legal due diligence. The parties have, signed a letter of intent, and now we must move to legal due diligence. Hopefully, a lot of issues have been identified pre-LOI, as Craig indicated, but now there's another party involved. Now the buyer's counsel is engaged. They're starting to dig into the operations, into the seller, and so legal due diligence starts. And as it's a necessary evil, as Abe alluded to. It's an arduous process. It requires the practicing physician and his team to work together to provide all the documents necessary or as requested. And that can be difficult sometimes because the sellers are practicing physicians. And so getting ahead of that and making sure that we do a lot of the diligence pre-LOI can help. But even if it's done, the buyer will still start to request a number of items. And so what's the purpose of legal due diligence? The buyer is identifying legal risks and attempting to mitigate those risks by identifying them and asking more questions. The process is the buyer's lawyer will send over a request list. Depending on the size of the deal, the request list can be extensive or it can be short. Our role would be to respond to those, provide the necessary documentation, and then eventually take all that information and to create what's called disclosure schedules, which we'll discuss when we get to a discussion on the definitive agreements. But ultimately, the due diligence can be protective of the seller because it identifies risks for the buyer, and the parties can know about those risks, can handle those risks, can take care of anything that needs to be taken care of. Examples of requests would be, the governance documents, as Craig mentioned, loan and debt agreements, leases, employment agreements, insurance information, regulatory stuff related to HIPAA, disputes, your licenses. And so essentially the buyer wants to know everything about your practice and your operations so they can provide an analysis of any risks to their investors.
A couple other things on that front, just to kind of, we'll just, be brutally honest here. On the diligence side, it is typically the single most onerous, difficult thing that any seller has to deal with. Abe mentioned before, there's operational considerations when you're dealing with the process, and in our experience in the hundreds of deals that we do every year, it's the issue of dealing with diligence and working with our clients to go through that process that typically, creates the most headaches. We get it. People have a business to run. They have patients to treat, and having to dig up old documents is never fun. So we always ask, that our clients understand on the front end that there are going to be times where it is going to be a little difficult. When you have to go back to the well 2 or 3 times to pull up additional documents, it's never fun. Part of the job of folks like Provident and us is to ensure that those requests are as limited as possible, to make sure that we're protecting our clients so that it's not death by diligence, so to speak, but that we actually get to a successful transaction. One of the other things I would add too is one thing that's popping up quite a bit in this current environment is you should expect that there's going to be a lot of questions about cybersecurity and about potential data breaches. It's unfortunate, but we do have clients at times that are the victims of malicious attacks where their protected healthcare information is stolen or accessed. There are potential reporting issues surrounding that and other disclosures that have to be made, and making sure that you have the proper counsel and a plan of attack to walk through those issues are very important. So let's go to the next slide if you don't mind. So the next step in the process is really getting to the definitive agreements, and I know many people on the call today are probably very familiar with these, but for those that are not, there can be a mountain of documentation that shows up in connection with any transaction. We've tried to really narrow this down to just a few key documents. There's a lot of other paper that gets pushed in these deals, but the 3 real key documents that most people need to be familiar with and should be expecting in deals of this nature would be purchase agreements, equity agreements, and employment agreements. The purchase agreement is really the operative document that's going to contain all of the critical deal terms for a particular matter. If you've done a really good job, working with a group like Provident to negotiate your letter of intent, you would hope that many of the key critical deal terms are laid out in your LOI, which means that the purchase agreement process is much easier because you already kind of know what to expect. But no matter what, there's still going to be some terms that are not laid out in the LOI, and those as well as the agreed upon terms are all going to be in your purchase agreement. Within the purchase agreement, in addition to purchase price, and if there's going to be any type of equity component, there's going to be representations and warranties. These are essentially commitments, promises, statements that you're making about your practice with regards to various different components like healthcare, compliance with healthcare, compliance with environmental laws, employee benefits. There's usually 20 to 30 representations or warranties that most buyers are going to request, and that's the reason why the diligence process is so important, because we work with you to try to identify any potential issues relevant to those particular representations and warranties. Another thing that's really important that all of our clients ask about is what type of restrictive covenants. Will there be non-competes in connection with the transaction? And the answer to that is yes, there will be non-competes. And because it is an acquisition involving the non-clinical assets of your practice, the type of non-compete that most sellers are going to be asked to abide by is a little bit more extensive than the non-competes that you see in connection with an employment agreement. We normally see non-competes that range anywhere from 3 to 5 years, depending on the particular market, the regulatory environment, and what the case law says about the enforceability of those covenants. There's obviously indemnification issues, which is going to be how much are you going to have to essentially pay if it turns out that you were wrong or you breached one of your reps and warranties within your agreement. If, for example, you fail to disclose a certain thing about a healthcare matter and it causes damage to the buyer, then they're going to ask for you to cover some of those losses. So that's indemnification, and that's a key component of any deal. And then there's also risk mitigation factors. Are there going to be deductibles? Will there be caps on your liability? Are there going to be materiality qualifications that you give within the agreement? All of these things are really the sandbox that your effective counsel plays in. That's where we do our job to protect our sellers to make sure they're not exposed to unnecessary risk, and that's the whole point of negotiating a purchase agreement. The equity agreement, I won't go through everything here, but this is going to be the documentation that facilitates your investment in the parent company. There are a number of key provisions within the documents. There may be various non-competes as well tied to the equity, but I would say that the most important things in there are what type of rights you're going to have in the company that you're going to be an owner in. If you are not a platform acquisition, your rights are going to probably be substantially less than if you are a platform practice. There will be questions about, will you be getting distributions? Oftentimes there will not be until there is a second liquidity event. It just depends on the deal. And then there's also repurchase rights. The question always comes up, when can they buy me out? Why can they buy me out? How much can they buy me out for? And can I ever leave? And can I sell my equity back? And these are all things that you have to walk through and you have to consider, because no two deals are the same. And we typically see that you're going to be expected to stay on 3, 4, 5 years. You may not be able to sell all of your equity back, but you should be able to sell back a significant portion, and in some cases, even all of it. And in many instances, you'll be able to sell at the same terms that the buyer gets in a recap event. The employment agreement's fairly straightforward, but if you sell and affiliate with a larger group, oftentimes you're no longer going to be the owner, but you will be an employee of the practice that you previously owned. You may go to a % of collections, and you're going to also be bound by restrictive covenants. One of the things that I would just point out there is that oftentimes, again, those restrictive covenants will be significantly shorter in your employment agreements than what you're going to see in your purchase agreements. So let's go to the next slide, please.
All right, so moving on to post-transaction, right? So typically these are the things that we see after a successful transaction is finished. As Craig alluded to, you're going to have employment obligations to remain on and to be a continuing practitioner. There might be an earn-out concept. The success of the practice, the growth of the practice may yield, a cash payment to you a year or two down the road. Related to the repurchase rights that Craig mentioned, ideally the buyer wants to ensure that the equity holders are going to be good corporate citizens. And if they're not, then there could be repurchase of their equity at a heavily discounted price. And so, that's a key negotiation is how to handle what types of events trigger the repurchase and at what price. Abe alluded to everybody's waiting for that second liquidity event. One of the things we're seeing, as these platforms become a little more sophisticated, is how to handle a situation when we get to a second liquidity event and the buyer, the subsequent buyer, being concerned that all of the rollover participants, all of the doctors who've invested, will cash out and leave. And so we're seeing a lot more movement to force these sellers to have to retain a certain amount of equity to incentivize them to stay on for that third liquidity event, the fourth liquidity event. And for those that are, generally for the platform acquisitions, they have a large role in the management and development of the platform. And so they are out there helping to grow the group and to create new regional platforms as well.
And on that issue too, like Dean said, on that second liquidity event, I mean, one thing that we always tell our clients, and that we work with is, what are your expectations? And once we know that, I always recommend that those are communicated to a buyer early on. Most buyers that we know in the space are more than willing to work with you. If they know that your window is 5 years, maybe you're more senior and you're thinking about retirement, is just working with a buyer on a transition plan. And most buyers will actually appreciate that. And there will be requirements to obviously cooperate with a buyer and try to find an adequate replacement. But if you know something in advance, you can negotiate that point early on, and then there are no surprises. And so, at least in our experience, we found that to be effective. And most people aren't going to sit there and hold you over the fire if they know in advance and they have a plan for your retirement. So if we can go to the next slide, please. So, this is just a summary. I mean, frankly, we really kind of went through everything. I think in the interest of time, we'll probably move through this here pretty quick. The two things that we really didn't touch on that I just wanted to point out here is that, we have this thing, definition of cause. This tends to be, a heavily negotiated term. Cause is, what grounds would the practice or the management company have to terminate your employment? It's a heavily negotiated point because oftentimes your equity in the parent company is tied to you still being an employee. So, we have to work closely with our clients, with a buyer, to make sure that the definition of cause isn't so broadly worded that they could get rid of you for anything and everything, and then your equity would basically be surrendered back to the company at a heavily discounted price. So in deals like this, that language becomes much more important than what it otherwise might be just in a standard employment agreement. The other thing is the earn-out contingent payments. The only thing I'll say there is they're not present in every deal. An earn-out or a contingent payment is simply, money held back or a money that will be paid if you hit certain targets down the road. Not every deal has this component. Sometimes we find them where, someone has gone through the quality of earnings process. The numbers haven't come back quite where they wanted them to be. And so perhaps a buyer inserts kind of this earn-out structure into the deal because they just want to make sure that, look, we want to treat you fair. We'll still give you an opportunity to kind of get back to where the original price was, but we might hold some money back until you hit that target. The only thing I would say on that is, earn-outs and contingent payments have a pretty heavy regulatory component to it. They have to be looked at from the legal side to make sure that they comply, with state and federal, anti-kickback and applicable, federal laws. And so those things do have to be looked at because that's a really important component to the deal. If we can go to the next slide, please.
Finishing up here, we have the benefits and the risks of entering into a transaction like this. Benefits, obviously, a big cash payment. The potential investment upside of investing into a platform or to being the platform. Now that you've sold and you're still the PC owner, you get to focus more on medicine, focus more on the clinical aspects of your practice, less focus on the administrative, non-clinical functionalities. Some of the risks, it's an investment, so there is a potential downside. There is somewhat of a loss of autonomy, not on the clinical side, but on some non-clinical decision-making. Most of the sellers we represent don't employ themselves, and so you have this concept of now you're an employee versus a business owner. There's tax considerations there. Most of the time, there's a less yearly take-home cash as an employee. So handling that, you're burdened by restrictive covenants, and there is the potential that you could partner up with somebody that you ultimately don't enjoy working with.
The other thing on that point too is that, not all, potential partners are equal. Some have really strong regulatory environments. They have regulatory teams in place that are making sure that everyone is dotting their I's and crossing their T's. So I always counsel clients. I think that's a very important factor to understand what the regulatory environment looks like with a particular buyer. And then the other thing that is important to understand is when you're joining a much larger operation, one that may have affiliated practices in multiple states, the risk, the regulatory risk goes up a little bit because perhaps that particular partner has affiliated practices in states that have a much more heavily regulated environment. There are some states within the U.S. Where it is somewhat less restrictive than others. And so when you join a much larger operation, you're subjecting yourself to really not only the regulatory environment in your own state, but wherever that management company operates, you could be exposing yourself to risk in other states where you don't even practice medicine. So those are things that always have to be looked at. Next slide, please. So at the end of the day here, I know we're running out of time, so I'll be quick here. As we kind of discussed, where does a lawyer, where does a law firm fit into the picture? As we kind of discussed throughout here, we'd love to be involved as early as possible because we think that in getting involved in early, even before the LOI is executed, there's a number of things that can be planned for, whether that be tax structuring or any type of regulatory issues that can be dealt with to kind of help get everything in good shape as you're going through the process. We in particular, we do a number of transactions each year, so we're very familiar with the market and what market terms would be, and what your expectations should be when you're going into those negotiations. We have a lot of materials and research that we rely on, and kind of just knowing what market terms look like. That comes up all the time. What is market? And that's what your lawyer should be able to tell you. It is a regulated industry, so there's certainly federal and state laws that have to be looked at and complied with. And that's what your legal team is for. And then, there's other issues that always pop up, at a firm like Dykema. Like I said, we're in over 60 different industry and particular legal, industry groups and legal matters and types that we handle. And so whether that be real estate, employment, benefits, tax, or regulatory, your counsel should be competent and to be able to handle those things. With that, again, just thank you for your time today. We really appreciate it. I'll kick it back over to Abe.
We'd actually like to open it up to questions. So if anyone has any questions, you can find the Q&A box at the top or bottom of your screen, which is in the control panel. You can just type your questions in there, and the attendees will address them.
All right, I see our first question. Our practice has been approached by a DSO. What are the differences between partnering with an oral surgery private equity platform and a DSO? So this is a good question. Actually, over the last couple of years as well, a lot of DSOs have shown interest in partnering downstream with oral surgery practices and capturing that additional, that additional referral volume. There are a couple deals that have been done. North American Dental Group has bought a few oral surgery groups as well as Dental Care Alliance. I think the challenge and what you want to, every situation is different. The challenge with those deals and what you want to evaluate, will a partnership with a large kind of, dental practice management consolidator, will that have any disruption on your current referral streams as an oral surgery practice? I think one of the reasons you've seen private equity get focused on pure play oral surgery practices is because there is no disruption in the referral streams in a transaction like that. That being said, there certainly can be benefits in a DSO partnership for an oral surgery group if the opportunity exists to leverage the referrals that DSO can bring to your platform if they have a lot of concentration within your specific market. So it's a case-by-case basis, but it's something you want to look at in every process.
All right, we have one other question here. It says, the question is, how long are doctors being asked to stay on post-transaction? It's a great question. We get it all the time, and the answer is it varies, but normally it's between 3 to 5 years. And I think some of the answer is also driven by how large is the group, that's coming over. Oftentimes you'll see, 5 to 10 doctors that are rolling into a private equity-backed venture, and it may not be the case that every single person in that group has the same deal. Some, where you have kind of the original founders, they might be reaching an age or a time when they're looking to retire, and so part of that is kind of built into the buyer's evaluation of the practice. And if the expectation is that 1 or 2 people are looking to retire early on, then like I mentioned before, there's usually an increased focus on making sure that the other owners and the other associates who are coming up, have the training they need to really take over and replace the production of the doctors that are looking to retire. So, so again, typically we're seeing 3 to 5 years. Normally that's going to be the case if they know that other folks are going to be staying on. And as part of that as well, a lot of folks, they want to make sure that there is a transition plan in place to make sure that someone is there and available to take over for the doctors that are looking to retire.
One last question here. What would you say is the average EBITDA of a single oral surgery practice and the multiple for such a buyout for PE or DSO backed? So typically the average EBITDA, I would say, for a oral surgery practice with 3 to 4 surgeons, typically we see EBITDA in the $2.5 to $3.5 million range. The multiple on those can range from around the kind of mid to higher single digits, so think probably 7 to 9 times that number, and can go much higher for if the group would be considered a platform, or if there's a lot of infrastructure, or if the EBITDA base is a bit larger. I think generally, whether it's a PE, kind of group like U.S. Oral Surgery, or a DSO like a Dental Care Alliance, North American Dental Group, the valuations actually come out to be pretty much in the similar range, unless there's a unique aspect that the dental group thinks there's a lot of synergies from potentially being able to shift some of those referral volumes, or the oral surgery group, an oral surgery group backed by private equity sees a lot of opportunity in synergies with their current platform or opportunity for expansion in the region after. It's a good question. Thank you.
That's actually all the time we have for today. If we didn't get to anybody's questions, you can feel free to reach out to the panelists directly. Their information is on the screen. And we will also be sharing this recording at the end of this week, so you can feel free to reach out to the panelists when their information is distributed that way. Thank you so much, everyone, for joining. Enjoy the rest of your day.